afternoon, everyone. Thank you for joining our webinar series today. My name is Tyson Mavar. I'm one of the retirement-focused advisors here with the Retirement Group in Texas. On today's webinar, we wanted to talk about some what we consider to be very important issues related to retirement accounts, specifically with saving money on taxes. And even more specifically, as it pertains to Roth IRAs. Many of our clients, especially lately, have been asking us about Roth IRA conversions, Roth IRA contributions, what to do with after-tax money in their 401ks. And we've been encouraging our clients to take a series of steps that we believe are going to allow them to minimize their lifetime taxes. But you have to first understand the rules and how some of these options work. And for most people, we've found that there's some great ways to reduce the uncertainty of taxes in the future and increase the probability of paying lower taxes so as to have your money last longer or to be able to increase your retirement paycheck, whatever is more important to you. So for those of you who aren't as familiar with us, the Retirement Group is an independent financial planning company. We manage retirement assets for corporate employees across the country. We have a variety of different companies whose plans we focus on. I focus on a lot of the telecom companies and oil and gas companies here in Texas. We have advisors across the country and work with a variety of different corporate employees. Chances are, if you're on today's call or watching this as a recording, you work for one of the companies that we have worked with for many, many years. And even though we're not affiliated with or endorsed by any of these companies, we have many clients and advisors that have gone through the process of helping somebody retire from a company. And many of you know some of these retirement benefits plans are challenging to understand and complicated in many cases. So we hope to be able to be a resource to you in your approach toward retirement, as well as through your transition. If you decide to use an advisor, we hope that you at least consider doing some business with us when the time comes. One thing we do complimentary for anybody who spends some time on our webinars or is willing to spend some time with one of our advisors is a cash flow analysis that we've developed over the last couple decades that we've been working with corporate employees in an effort to help people understand, number one, where do you stand with regards to your retirement? Are there things you should be doing now to improve your position to retire at some point in the future? When's optimally going to be the best time to retire or leave your company, even if that doesn't necessarily mean you're retiring? And then ultimately, are you on track to make sure that you understand how much money you're going to need when you retire and how much money you're going to be able to afford to spend in retirement so you can start getting your ducks in a row, making sure that you have a comfortable retirement and ultimately don't run out of money. That's our primary objective as retirement income advisors. So if you'd like that cash flow analysis, you can call our home office to schedule a call or a web meeting with one of our retirement specialists here at the Retirement Group. I also encourage everybody, if you aren't yet following us on LinkedIn, if you do so, you'll make sure that you get different content as we come up with these tax law changes that we're expecting to come pretty soon here. If your company is changing the benefits plans, we'll normally cover those on the webinar. So follow us there. You'll make sure not to miss a beat when it comes to some of the upcoming changes that we think are relevant when building a retirement strategy. All right, so Roth conversion. A Roth conversion is where you take money from a pre-tax retirement account, such as your 401k, your traditional IRA, maybe even your pension if your company offers a lump sum on your pension. You pay the taxes, and then you move that money into a Roth IRA, which is an account that is not only an after-tax account, but it grows tax-free. All the interest, earnings, and growth on the investments in a Roth IRA are tax-free, and they're tax-free for the rest of your life. They're also tax-free beyond your life. If you don't spend those monies during your lifetime, they're going to be a tax-free transfer of wealth to your beneficiaries, whether it's a spouse, your children, grandchildren, maybe a cause that's important to you. Great benefit in the tax code through a Roth IRA. Now, people are very limited on how much they can contribute to a Roth IRA on an annual basis. And some of you may actually make too much money to contribute directly to a Roth IRA. But there's some good workaround rules that we're going to talk about on today's webinar. And these are some of the probably the most valuable conversations I have with my clients and also with people that talk to us for the first time. People that are otherwise very intelligent at investing money at taking advantage of their benefits plans. Very rarely we found understand these rules on how you can get a lot of money into a Roth IRA and substantially improve your probability of success in retirement. So let's talk about a few of these. First, let's talk about the non-deductible contribution to an IRA. This used to be the only way to get money into a Roth IRA for folks that made over the income threshold. So the way this works is you make a non-deductible contribution to a traditional IRA, and then you subsequently convert that after-tax money, as it were, into a Roth IRA, giving you the ability today to put up to $7,000 a year into a Roth IRA. You just have to use your traditional IRA as a conduit, so to speak. Now, this can get muddy if you already have pre-tax money in an IRA, because it's going to be a proportional, it's going to be proportionally viewed when you do this conversion, meaning that they're going to potentially tax you on some of the money that you're moving. So it's not the best way to do this, especially today when a few years ago, the IRS has changed rules on how you can get money out of your 401k and into both traditional and Roth IRAs. So let's talk a little bit about this. That last one we talked about, we call it a backdoor contribution. This is called a super backdoor, and this is an unofficial name, but it's what we at the retirement call a super backdoor contribution to a Roth IRA. So this is where we find it's really, really important to have your advisor know a little bit about your company benefits plans and the 401k rules specifically when it comes to the super backdoor contribution. Because each company, I'll give you an example here. I work with ExxonMobil as one of the companies whose plans I specialize in and work with a lot of people that work for ExxonMobil. Everybody has a contribution limit into their 401k, at least if you're over 50, of $64,500 per year that you can put into your 401k plan. Now, this is a combination of pre-tax and post-tax, and it's also a combination of what you put in and what the company puts in. Now, ExxonMobil, in my example here, they have a maximum contribution to their plan of 20% of their employees' salary. They also suspended their company match, so it freed up a little bit of space for people to put money into the after-tax bucket on their own terms. But this is an example. Most companies don't have that percentage of their income limitation on how much you can put into a plan. So we've actually done an example here where we showed one individual who was able to put $36,500 into a Roth IRA by using their 401k as a conduit. And so we're going to go into this example here so you can see a little bit on how this works. All right, I'm going to zoom in here because it's sort of a small picture. So here we have a 401k plan. If the person is under 50 years old, their annual contribution limit is actually $19,500 per year. That increases to $26,000 per year on a tax-advantaged basis after you reach age 50. But this individual is under the age of 50, so they don't have that catch-up contribution. Their maximum tax-advantaged contribution, and when I say tax-advantaged, that means you could be putting in pre-tax to get a tax deduction for the year. You could be putting into the Roth 401k in an effort to get tax-free growth on that money, or a combination of the two that cannot exceed $19,500 if you are under the age of 50. Now, what most people don't realize is you can actually put more money in your 401k than that limit. It just have to go into an after-tax bucket, what we call spillover contributions. But because of the total contribution limits that the IRS imposes, the person that's under 50 can put an additional $36,500 into their 401k plan, effectively giving them the ability to get $36,500 into a Roth IRA. Now, how do they do this? Well, in this case, their employer's contribution was $2,000, so it reduced the amount that they could get into the Roth IRA because that $2,000 counts toward that limit that they have for the year. But most employer plans allow for what they call an in-service rollover. Well, while you're working, you can actually put money into either a traditional IRA or a Roth IRA from your 401k plan. So again, this is where it helps to have your advisor know a little bit about your company plans and maybe have a track record of working with people in the same shoes as you, somebody who's been an employee of your company. And this is also a way that Retirement Group, by the way, starts relationships with a lot of our clients, because we don't recommend waiting until the last minute to choose an advisor or building a track record with an advisor at the last minute. This is a good thing to start well before you retire, at least in our opinion. So if you think you might work with an advisor, it's often a good idea, we think, to open a traditional IRA or open a Roth IRA, or maybe open both, depending on the dynamics of your current 401k plan. Move some money into that account, allow one or multiple advisory groups to manage these accounts for you and see how they do, not just on the performance, but was the advice good? Was the knowledge good? Was the communication good? Was the performance net after their fees good? All the things you probably want to see from an advisor. This is your opportunity to sort of test out, make sure the proof is in the pudding, and make sure that they're going to do good work for you when potentially you entrust your entire retirement nest egg with them. You can do that with a smaller amount. And if your company offers an in-service rollover option, this is one benefit of that, potentially, to test out services or one or a couple different retirement groups. But this tax advantage that you can get by moving the after-tax money from your 401k into a Roth IRA is one of the bigger benefits in the tax code currently for retirees. That's our opinion, because you can actually contribute, in this individual's case, $36,500 a year into their Roth IRA, whereas some of you may not be able to contribute any money to a Roth IRA if you make too much money. And those of you that don't make too much money are still limited to only putting in $7,000 a year if you're over the age of 50, whereas this is a way you can put up to $36,500 into your plan. Now, one thing to keep in mind here is, what's the detriment of cranking up your contributions to your 401k up to $64,500 for the year? Your paychecks are going to be a lot smaller. So if you're somebody that has non-qualified money, whether it's in a brokerage investment account, a non-retirement account, maybe it's savings in the bank, checking a savings account, great way to utilize a strategy is by increasing your contributions, but then withdrawing from these non-qualified accounts to essentially supplement your paycheck and allow you to get more money in the Roth environment. Effectively, what you're doing is getting money from a non-qualified account into your Roth IRA. You're just doing it indirectly through your 401k and effectively allowing that money to now grow tax-free, whereas where it might be now in a non-qualified brokerage account or your bank account, it's growing taxable, unfortunately. So these are what we find to be great ideas for a lot of people that are approaching retirement that have 401k plans or have employer-sponsored plans. But every plan's rules are different. So we encourage you, talk to one of our retirement-focused advisors at the Retirement Group, or maybe ask your advisor if you already have one. If they look like a deer in the headlights when you talk to them about this, call us and we'll walk you through how it works. And this could be a way for, if you're considering working with an advisor in retirement, to see if it's a good fit, to have them manage some of your money before you retire, and also get you some more tax efficiency within your retirement accounts. Now, unfortunately, folks, 74% of Americans over the age of 50 do not have a written retirement plan. This is unacceptable, in our opinion, especially when so many groups like the Retirement Group are willing to run a retirement plan for you for free in an effort to get to know you and for you to get to know them, so that they might be able to have a higher probability of earning your business. Take advantage of all of the services that are available to you today. Retirement Group has a cash flow analysis. We do complimentary. Usually it takes about 10 minutes over the phone to put it together, and about 30 minutes to go over the phone or in a web meeting or even an in-person meeting, go over the results with one of our retirement advisors. And all we ask is, if you get some value from that, certainly consider doing some business with us. But even if you're planning on doing things on your own, or you already have an advisor you're comfortable with, you can also help us by just telling a couple of your coworkers about us. That's how we've grown our business over the last 30 years. With that, we're going to wrap it up today. I appreciate everybody joining today's webinar and conference call. If you'd like to schedule a meeting with us, or just maybe ask a few questions about your company's benefits, the QR code on the left here will get up a calendar that will get you on one of our advisors' calendars, so you can have that call. Or just email us any questions you have, info@theretirementgroup.com. And you can call us as well at the home office at 800-900-4500. 5867. We'll do our best to help you out and get you in the right direction, folks. We appreciate you spending some time with us this afternoon. I hope everybody has a wonderful, safe weekend, and we look forward to talking to you all again very soon.